out. And let's talk about it. Kidding. Obviously, the market is the lead, Dan Nathan.
Yeah, I mean, listen, guy, you say this all the time. While actually, which I think is really important, I think you have a good track record doing this. You're going to say today is a day that I think you want to bookmark, right? You want to kind of remember this day because this is really, listen, there have been bits of soft inflation data here, okay, that's basically kind of led investors to think that maybe the Fed could take their foot off the pedal a little bit here over the course of, let's say, the last 6 months or so. But today's reaction, not just in the stock market, but also in the bond market, is pretty powerful. When you put those two things together, you see here's a couple hot takes that we have over the Twitter machine from some people that we follow quite closely. The Fed's message saying that, listen, one piece of data, I'm paraphrasing here, does not make a pivot. Is that what you would kind of take away from Mester's comments on CNBC?
This is why, yes, and this is how I would sort of synthesize it. I'm sure behind closed doors, they're thrilled that things are trending the right way, but they also want to say, listen, let's not get ahead of ourselves. Let's continue to focus on things. We want to make sure we get this under control. So they're saying all the right things. They're having the data gives them the latitude, I think, to speak a bit more hawkish. So it's working out. And I want to be very clear. I mean, it is working out. I think their ability to vocalize and explain what they're trying to do, I think they've done a much better job over the last few months. What the market does is what the market's going to do. But I think they've all been pretty much on the same page. So this number, softer than expected, still elevated, again, gives them a little latitude to speak as hawkish as they want to speak. That's my interpretation.
Yeah, and I guess what the bond market is saying, and what if you look at the CME FedWatch tool, we have this meeting coming up in a few weeks in December here, and it looks like very squarely that a strong likelihood of only a 50 basis point hike. And again, I mean, this is one of the reasons why, if people can start seeing, a slowing of the pace, we've had 4 consecutive 75 basis point hikes, and then you get to the new year, 2023, and maybe sooner or later, the data, we just have a string of softer data like this, and maybe the Fed can take their foot off the pedal and say they are at that point data dependent. So I don't know. I mean, it's interesting, Guy, when you think about this, where my trepidation about the broader market into year end was that, and you've been saying that 4,100 could be easily in the cards here, was how poorly mega cap tech has acted over the last few weeks. We saw a bunch of reports and guidance that sent these stocks lower, all but Apple, but then obviously Apple filled in its entire upwards earning gap, so it moved lower and made a new low here. And so when you think about the NASDAQ 100, or we like to look at the QQQ, how close it was at its lows yesterday to the recent lows in the cycle, there's a lot of room to run. And as Market Call viewers know here, I've been picking at some of these stocks on these gaps lower. I bought some Meta, I bought some Amazon, I bought some PayPal, I bought some Google. But these are going to be trades here because I don't know about you, Guy, I don't have a ton of confidence that we're out of the woods as it relates to earnings revisions, because the headline today, this morning, is that Amazon, led by its CEO, Andy Jassy, who's only been in the seat for a little more than a year, is single-handedly overseeing a cost reduction plan. So a lot of these companies are taking this very serious. Meta had that announcement about jobs cut earlier in the week. I just don't think we're out of the woods yet.
No, and I apologize for the dog. So I'll say this. So this is the problem that the Federal Reserve is going to have, in my opinion. Again, what you're seeing today, and we'll talk about this, obviously, the dollar's backing up, something that you thought would happen.
Yep.
Rates are coming in, something you thought would happen, which on the margin are good things. The problem is the commodity market will take its cues from that, and commodities will get back on their horse, which will then elevate inflation, and we'll be right back in this. So you're going to have this cycle for a period of time, I think, where you get good data, the market behaves like it should. In other words, the stock market goes higher, yields go lower, dollar goes lower, but then commodities get back on the horse, which fuels inflation, which requires them to do more and more. So that's where we are right now, I think.
But don't you think it's interesting, Guy, that, crude oil is up less than 1% today? 2 days ago, we detailed a bearish trade idea on the XLE and the options market that I put on. The XLE massively underperforming, the broad market. So, to me, when I look at this, there's a chance that maybe crude doesn't get going in some of these other commodities, and maybe you'll see a rotation out of energy stocks. And, so I don't know. And I also think it's interesting that, this midterm ended up being much closer than I think anybody thought. And, I kind of came up with that little FMAGA, the Facebook, Microsoft, Apple, Google, and Amazon, because to me, for the last few years, that was the stock market. The direction of them, you know what I mean, was the key. When you look at today, the outperformance, you look at the size of the market caps of these companies and the performance that they're having on a week, again, where I think a lot of voters in this country basically said F MAGA. So I'm just going to tie that little bow on that one there, guy.
Nicely done. So this is what I'll say. Did their businesses change in the last 24 hours? Absolutely not. And to your point, are you going to see earnings revisions because the stock market's going higher today? No. Again, the problems that the market's been facing haven't gone away. This print helped assuage some of the concerns, some of the inflation concerns, but the slowdown concerns are still there because, quite frankly, companies are telling you that things are slowing down, and they're telling you that they're starting to lay people off, and they're telling you that margins are being compressed. So all those things are not bullish. Again, the stock market reaction is bullish, but that does not help impact any way earnings or earnings growth from here on in.
But couple things here, and I'd say this, okay? So let's just talk about some geopolitical headlines that could help earnings, okay? That would cause yields to go lower, would cause the dollar to go lower. So you saw this headline that Biden's going to be meeting with President Xi in Indonesia next week, okay? That's potentially a really good sign for some kind of easing of sort of tensions, right? You saw that the Russians are pulling back from some areas in Ukraine, right? So maybe there's a potential for some sort of easing in that situation. So, when you think about where we were a year ago at this time, we were worried about the Fed battling inflation. We were worried about the Russians invading Ukraine and disrupting supply chains. We were worried about zero COVID at China. You know what I mean? Like there's the potential that we could get into 2023 and maybe the world looks kind of less dramatic than it had been for the better part of this year.
No, absolutely. Listen, of course, there's absolutely that potential. And there's potential, for things, why are the Russians pulling back? I mean, who knows what the thought process there? They're going to try to stage another different type of it. I mean, I can combat those arguments, but you're right. Those things could absolutely happen. And I think a lot of people are starting to get on that bandwagon. President Biden meeting President Xi, is that a good thing on the margins? Yeah, I guess. Is it going to change this deep-rooted belief that the Chinese have that they want to be a global dominant power? No, probably not. But in the short term, again, it assuages some of the concerns. So I think you bring up good points. And the market is behaving exactly like that. Listen, yesterday's sell-off had everything to do, and it will come up at some point in the show, with what was happening in the crypto world, I think. It had nothing to do, again, with inflation, Fed, all those things. That was just a one day's worth of noise. So a lot of cross currents still, they haven't gone away. But again, we've said it since October, I think, what was it? I think the 13th, 14th.
14.
And the 17th that, we thought when the S&P traded down to 3491 that the potential move to 4,000, maybe an overshoot to 4,100 was in the cards into election. And here we are. So it's all sort of lining up the way we thought.
Yes, sir. All right. Well, here's one thing. I have to change the way I'm lined up. I have some bad lighting in my situation here. I look like a hologram or something. Why don't you bring Carter in? One of
those fun movies. Carter Worth, get in here. You
get in here.
You look like you're behind your protective glass there or something.
Look at the zoo.
So Carter, I'm going to go off screen for a second here.
You're in the Pope Mobile or something there.
I love the Pope Mobile. How are you, Carter Worth?
I'm all right. How's it going?
No, so good. So you heard some of the things we were talking about, and quite frankly, I think things are shaking out in sort of the way you thought they would as well. I mean, the back and fill in currencies, the back and fill in yields, the potential for the market to go up in the short term off maybe, an oversold condition a couple of weeks ago. So just talk to me about today's action, because everybody's all hyped up on the Mountain Dew.
Exactly. Well, I mean, intraday action, if it was 350 and we were like, wow, S&P's up 7, what just happened? It all just depends on how you close. We know that, right? And so if we were to fade, not going to happen like that. But here's the thing. I was just looking at this. So what has really happened? Nothing has happened. 10-year yields have gone to 3.8%. I'll read this to you right here. Just like 10-year yield surged to 3.8%, highest level since 2010. This was just in the news September 26th. That is the headline. High yield surged to 2.8%, highest in 20 years. Now it's we're at 2.8%, same level, but listen, it's a game. Apple's earnings were no good. Google's were no good. Amazon's were no good. Meta was no good. And the stocks are up because the cost of 10-year money is at 2.8%. And yet on September 26th, the article was they're surging to 2.8%. The market's terrible. It's nothing.
No,
what
listen.
we know is the bounce. Yeah, you always get bounces. But the way this ends, more likely than not, is lower dollar, lower yields, and lower stocks.
Right. And that's something you've been saying for a while. So let's look at your S&P chart, because you have the arrows and the lines to back this entire thing up. And by the way, this is not you saying this in a vacuum today. I mean, this is what you've been saying for quite some time, and it's playing out right before our very eyes. You've actually said, and I've said it as well on different shows, that in the knee jerk for yields going lower, the equity markets will go higher until people figure out that they're going lower because things are slowing down and because the growth is slowing, which is not a bullish thing. So here we are, an S&P chart. The lines draw themselves. You have the arrows. I think this suggests that there's a potential at the end of the year to trade around 4,000, which, by the way, I mean, that's something we've been saying here for a while.
Right. So I think the hope with the very clear colors and you see of course, the vertical line for the end of year, we've got about 35 sessions left. And the best case is you were to get to that downtrend line in effect since the Jan 4 high depicted in green, or we sort of continue to muddle along here. But what is important is this, that right now we've simply recovered to where we were last week.
Right.
I mean, so look at the price in the S&P, the level, and it's where we were at the high last week. We've just simply reversed losses from the preceding 6, 8, 10 sessions. It doesn't feel to me as though it's got a lot of follow through. I think we're capped, stuck, we're contained by those green trend lines that you see.
So I'm going to make a comment before we go to yields, but keep this chart up, because if you look, in the beginning of the chart in September of last year, you had a series of higher highs and higher lows, and we were in an uptrend. It made sense. And every time we traded up to that uptrend, we came off, but we bounced again. Things changed in December, where we've made a series of lower highs and lower lows. And quite frankly, we could trade up to or around 4,000, and that pattern is exactly the same, right? Lower highs and subsequently probably lower lows. So this is a good one just to have in the back of your mind, because again, in a bear market, we're seeing a bit of a rally, but that happens, to the point you made earlier, all the time. Let's look at yields. You brought another chart along, again, with lines so people can see them, because I think that's very helpful.
Yes, I think we've got maybe one or two iterations on yields, but I mean, the point about levels and trend lines and other reference points is that more often than not, they serve as a compass when you're in the dark. Because let's just talk about 10-year yields. If you ask any economist, did you know that 10-year yields were going to go to 30 basis points? Didn't think that. The worst single, and this is ironic because I started in fundamentals, when they put out payrolls, that's the most observed number. 40 and 50 economists put in there, we think payrolls will be this. It is never right.
It's true.
Okay. What is right, more often than not, with its own error rate, is a good chart. And this is a good chart, not because I drew it, because look at those lines. Those are mathematically parallel blue lines. And like a perfect sort of pinball machine, when rates have hit the upper and lower band, they have responded to the penny. And what we're doing now, of course, is we're backing away from that upper band.
Dan Nathan is joined.
Hi, guys. I love this chart. I tend to look at some stuff. I mean, we've been focused on that kind of shorter term one, Carter, that just shows that kind of really steep uptrend from early August, and the 10-year yield went from 2.7 to 4.21 here. And if, this break is meaningful, and to me, if you look at that prior high that you have identified, you're back at 3.5. And Guy and I were talking about this yesterday, Carter, on Market Call, basically saying that, there's a world where 3.5, 3.25 in the 10-year yield is a really healthy thing. I mean, think back to 2018, Guy, when, Fed Chair Powell was raising interest rates a quarter point every meeting, and they got to about 3.25 or almost to 3% in Fed funds, but the 10-year was 3.25. I mean, without that global growth fear, that might have been the path to normalizing rates in a way. So I think we can all agree that nobody wants to see rates crash. To your point, guys, if we saw the 10-year yield come down, it would be reflective of growth. It'd be reflective of flight to quality. There's a level that makes perfect sense, especially if inflation's coming down here. So to me, I still like this move lower in yields, at least to 3.5% by the end of the year, and maybe 3%.
We're going to try something on the fly here. Mickey Rat asks, and Jacob, if you can put up an XLV chart, can we discuss the healthcare stocks? So the XLV, I think 9%, 9.5% of the XLV is Johnson & Johnson, but then you have Lilly, Pfizer, AbbVie, those types of names. But this has been a monster, Carter, and this is something you've talked about for a while. We're probably at levels that we should fade here. August, September, we traded up to these levels. Maybe we've overextended. Their double bottom is well intact. But what are your thoughts here in the healthcare? Because if things are going to rotate into sort of higher valuation names, healthcare will probably take a breather.
Right. So in and of itself, just looking at that chart, and you didn't know it was XLV, it was just a white background with black bars, you'd say bearish, not particularly; bullish, not particularly. You'd say that's what a pair of twos is. It has no character. But what is important is the relative strength exhibited by healthcare to the market. And I continue to like healthcare as an overweight.
As do I. Home Depot you brought with us because it's the move today. And again, some of these individual stocks, we could probably rattle off 50, but Home Depot is one today where it looks like we're through that downtrend line. And who knows what it means? Maybe it means we trade up to the highs we made, I don't know, midsummer, late summer.
Right. So obviously a gap, as is the case with almost all stocks today, news related, having to do with government data. But the point here is two. One, it doesn't breach its June low. Market does, it doesn't. That's what relative strength is. Two, it has now moved above that downtrend line. Now, the downtrend doesn't have that much authority. All I've done is connect 2 points, and today we've moved above and made it a third point. But if you were to use the 150 moving average, what you'll see, if we might have this, is that it's also starting to flatten. And if we don't, that's fine too.
No, we have it.
This looks like, to my eye, right, has all the care. Okay. And so the moving average flattening typically happens at the same time when you move through the downtrend. So if you do the downtrend line in red, here they are together. Basically, this is all that one would hope for what should be the beginning of an important bearish to bullish reversal.
Yeah, here's one, Carter, and I know you're looking at Home Depot today, not just because of the charts, but again, this was a knee-jerk also to the move in rates. And when you think about a group that's moving today, look at homebuilders. I'm looking at Toll Brothers up 11%. Lennar, let's take a look at Lennar up 13%. I see this thing, breaking out above its 200-day. Obviously, the 150-day would be not far off of that. This looks like a really constructive chart. It just made a new 6-month high today. It's pulled back a little bit. Is this the sort of continuation move that you'd like here? And again, I've heard you say numerous times over the last few weeks when you've looked at some charts that look bullish to you, the whole idea that in this last downdraft, they did not make new lows. This has to figure into that thinking too.
Right. So it had almost all aggregates and indices and asset classes have their June lows. So did crypto, Bitcoin. And then most things went back and revisited those lows. Some made new lows, some didn't. But this didn't. And the housing in general has not. And so this is very similar to Home Depot. I'd want to be on the long side, not the short side.
Let's look at a dollar chart, Carter, because Dan's he's been sticking with this and it's proven to be correct. You've made comments about this. You drew that. By the way, that arrow was drawn. I know we saw this chart a couple of weeks ago, and you suggested it's probably going to exhaust itself. The same conversation we had back in June that we said we're in an uptrend, but the dollar will exhaust itself. We'll probably trade to the lower end of the channel and then bounce. That's exactly what happened. We traded up to the top end of that channel as well, and we've come off. Difference here, though, maybe is that now we're breaking through a channel. Thoughts here in the U.S. dollar?
Right. So we put out a note to clients actually on Monday saying that we're going to approach the lower band, but not hold. We think it will break through. And that is because it's the equal and opposite. Notice how we slightly broke through to the upside, where that last arrow was drawn when the first judge was made. You're likely, just as you overshot there, you're likely to undershoot. And so that undershoot is underway. The only reference point that matters now, and I think we have it on here, is the 150-day moving average. And so there they are together. And I think we have it with just the 150-day to make it very clean. And that's where I will be flipping around the dollar short trade and at least covering the short, and then making the decision to either play for a bounce or not.
Yeah, if these guys can pull up the UUP, the ETF that tracks the US dollar index, and again, we've talked about this a lot, 50% of the weight of that ETF is the euro. We know why the euro has been so weak. And again, I do think it's interesting to have the break of this trend. You know, if you look at this thing, I mean, I guess from the get-go, I've been saying I've been playing for a move back to 28. And I think that gets, below that uptrend, but really kind of, does the job. It gets back to a breakout level. So in my mind, that's where I'd be taking that bearish trade-off in the UUP. Guys, I got to give you guys both props here. Carter, you had a note, I think earlier this week or maybe late last week, on gold miners. Guy, you've been talking about, I think you said it on Market Call, if there's ever a time for gold to hold, and you were looking at the GLD, it's right here. Are you guys a little bit surprised by today's continuation, given what we're seeing now? I get it. It maybe is just dollar related here, but it seems like, is there a need to run out and buy gold? It's forget the chart. You understand what I'm saying? Given what we're seeing across, risk asset markets right here.
Guy, why don't you go first? And then
is there a need to buy it? No, because every time you've done it on moves like this, you have not been rewarded. But I will say this I know to be factual: central banks continue to be net buyers of gold. It makes sense that gold is rallying here. One, technically off that really little short-term double bottom that we flagged, and B, because if you think about rates coming down, the headwind of a stronger dollar seems to be abating. And again, inflation's a problem, but if the Fed were to back away, it opens the door for gold to go higher. So, and coupled with that, the fact that crypto seemingly is blowing up before our very eyes, you add all those things into the mix, and it comes out for a pretty bullish equation for gold. So I don't think you're going to miss it to the upside, Dan, but I think you definitely want to stay with it. Carter?
Right. So it's ever thus with the circumstance of who one is in the market and what your timeframes are. So just looking at this chart, well, here's a chart with some nice lines. I did draw them, but forget the fact that I drew them. They're kind of tell the story. Is that a downtrend? It has multiple touches. Yes. Have we broken above the downtrend? Yes. Is it the setup of a triple bottom, which is to say it was not making new lows? But here is the issue, and it's what your time frame is. Do we chase something with new money right now? Well, take a look at the next chart. We're getting awful close to 100. It's the reciprocal of the dollar. The dollar's getting close to the 150 moving average, having sold off, meaning this is very encouraging. Ultimately, I think gold, because I think they're going to start doing QE 990. That's what this is saying, of course, because we are going to go into recession. But independent of that, it's a tough chase here. And so this is, in a perfect world, or to speak to derivatives, I would stay long and sell calls.
Yeah. Hey, Guy, so that's a really important point here. You've been saying that, if you saw a backup in yields, especially in the 10-year, that would suggest that economic activity is weakening here. And will you take the same thought away as that Carter just did, is that a continuation in the move in gold is greater confidence that the Fed is going to go from the aggressive tightening to possibly aggressive loose monetary policy to kind of be more accommodative, I guess, if we do have a weaker economy?
Well, I mean, Danny Moses thinks that's going to happen as well. And there are a lot of people that were talking about that in the spring of this year, the potential for it to happen in the spring of next year. I hope they don't do it because just the problems that we are trying to combat now will just come back in spades. But what'll happen if they do? Well, that dollar that's now challenging that 150-day moving average will break through it to the downside. Yeah. And gold, which is challenging the 150 on the upside, will break through. And all those things will come back in spades. By the way, you mentioned A Perfect World, Dan. I know you don't want me to do this, but great Kevin Costner movie.
Oh, yeah.
With Clint Eastwood and the guy from the President movie. Remember that? The West Wing, the guy, Whitmore. Whitmore.
Oh yeah, Bradley Whitmore.
Brad Whitmore.
That guy, I got to tell you, I don't know
He's
if
a
you guys are
political
watching it.
beast.
I don't know if you're
God.
watching The Handmaid's Tale, but he's like a tour de force in that show.
Which one is he in that one?
Yeah, he's the guy. He's Lawrence. He's the
Lawrence, who's
yeah.
kind of wants with the scarf and all.
No, he's just a great character. Guy, I'm happy that you did that. I remember
Laura
that movie.
Dern's in that movie too, but that's Bruce Dern's daughter.
Yeah.
And she's in all the Jurassic Park movies. Anyway, I apologize.
She is in that.
The Bitcoin. That's this. Don't bury the lead, Dan. This is your ballywick.
You say that. It's so funny because again, I think there's like wars going on Twitter about the Bitcoin here because all of these guys who had all the podcasts and the laser eyes and the 200,000 price targets and all that stuff, they're not there anymore. I don't see them tweeting about it. I think they shut down their podcasts and everything like that. And, I've always just found Bitcoin or crypto in general interesting because some of the smartest people that I know in tech and finance find blockchain technology really interesting. Again, I've been really skeptical of guys like Jack Dorsey who have like this religious belief in something like Bitcoin. So I haven't owned Bitcoin in years, to be honest with you. It's not something of interest to me. So when you say it's my ballywick, I find it interesting from an intellectual standpoint. But look at this. And Carter, I drew these lines. I'm just curious what you think. Again, this is not a log chart. We're going back to that last retail high in 2017 when that was just a frenzy, that retail frenzy, right? And here we are, and you made this point, I think, on Fast Money the other night. Everybody thought this kind of 19 to 20,000 range was support until there was another evident scenario of a Ponzi scheme. And look what happens. It drops 25% in a straight line. I guess I don't know how this doesn't go back and go to that kind of $10,000 level where it took off from in late 2020. Carter, thoughts on that?
Yeah. Where we are now, interesting, having undercut the June low, we've thrown back to it, right? So we've had a big ricochet over the last two sessions, and we're right back to the breakdown level, which is what the definition of overhead supply is. So how far down it can go? It can go as low as the imagination will allow. The main thing of all things, I think, is that more money has been lost in Bitcoin than made, right? Because there weren't as many people involved on the way up, whereas the involvement, the amount of capital since the peak has been tremendous, and that's basically puts you in a hell of a situation.
Dan?
Yeah, well, Guy, one thing I wanted to throw this chart.
I was going to say you got Bitcoin and software. I mean, two things
look
that
at
go
this.
hand in hand, apparently.
Both of them topped out to the day, 52 weeks ago, yesterday, I guess. And when you think about this, is that, software, not that these things, I think some investors were thinking of them in a similar capacity, the way they thought about risk and they were obviously well correlated, but that it looks like that's diverging a little bit. And I'm just curious, thoughts there, Guy, because would you rather buy crypto here or would you rather buy a bunch of software companies that have big market caps, big valuations, trade at 10 times sales?
So here you go. I'm going to answer that. I'm going to do the answer you don't see coming. I would submit that what's going on in the crypto world now is the market basically regulating itself, and it's weeding out some of the bad actors, which in the long run is probably be a positive thing. So this actually might be one of those inflection points in Bitcoin. So given the choice in the would you rather game, believe it or not, I can't even believe I'm about to say this, Bitcoin.
Wow, that's pretty fascinating.
I know you didn't see that one.
All right, but Carter, play the game, buddy. Would you rather Bitcoin IGV?
As a long, or I'd rather have IGV for sure.
Yeah. All right. Well, we did that. We played that game.
There was a guy named remember this guy Pavlov was his name.
Yeah.
I like names like that. Sounds like a hockey player, and he had a dog, right? And I guess what he would do is he'd ring a bell and then he'd give the dog whatever, and got to the point where every time the dog would salivate. It's Pavlov's dog. I mean, it's legendary. That's what's happened here on Market Calls on Thursday. All I got to do is say one frickin' word, and this entire comment section, I mean, I can just feel it lighting up.
It blows up.
All right. Want me to say it? You want Carter to say it? I'll say it if you want. Tell me who wants to say it.
Please,
Dan?
Say it. All right. But here's the thing, Guy. FactSet, our fine sponsor, they like to clip this segment. So we just had a little fun live on that. Let's do it properly.
Okay.
Let's give John
Here's the clippable part. Yeah. We can't finish up a Thursday without going to the great John Butters and the tremendous work that he does. And Dan, once again, we are going to highlight his Thursday note. So slide it, Earl.
All right. Well, you know the name. It is John Butters. He is the senior earnings analyst over there at FactSet, and he writes his earnings insight blog that drops every Friday morning, but he gives us a little bit of a sneak peek on Thursday's market call. And actually, Guy, special announcement, John Butters is going to be on market call with us, not just his note. This is going to be next Thursday, people. So tune in if you want to see the man, the myth, and the legend. But I find John's work really interesting because, you know, over the course of each quarter, as we're thinking about what the results are going to be, he's always given us little tidbits on Thursday, but I always find the postmortems really interesting too, because sometimes we get so caught up in some of the individual names as they're reporting, it's kind of hard to see the forest from the trees, if you will. But John, in his earnings insight blog this week, is talking about how investors have been rewarding positive EPS surprises. And again, you know, we've spent a lot of time on market call focusing on some of the big disasters that we've seen over the last couple of weeks, whether it was Microsoft or Google or Meta, you know, and Amazon all had 10% gaps or so. But what his work is saying is that investors are kind of leaning into to companies when they're beating. Now, he's also done a lot of work on how the average, you know, estimate has come down over the course of the quarter. So thoughts here a little bit, Guy, on we know that estimates have been coming down, and the companies that are beating lowered estimates, they're seeing their stocks pop at a greater rate than we have in the past.
You know, but and so here's, yes, all those things are great. And then this is my takeaway. The market is also punishing negative EPS surprises more than the average third quarter, which, you know what, in this environment, those companies should be punished. And what the further takeaway is, in a zero interest rate environment, nobody got punished ever. And that led to complacency and laziness. Now, as rates go higher, you know, today notwithstanding, Carter loves that word, companies are getting punished if they don't perform. And that's the way the market should operate. So everything that he put in this note makes perfect sense. And it speaks to, for the first time in a while, an efficient market, Dan.
Yeah, Carter, thoughts on that? Because
well,
I know
I think that, and we'd have to couple this with obviously the other work done by Butters, which is the revision. Analysts, look, earnings estimates going back to the 1970s typically revise 1% a month down, because that's why they call it the sell side. They're there to sell. And so they put these price targets that are not realistic, and then slowly over the course of the year, they move them lower. When you're in a down tape in a market such as this, where you drop 20 to 40%, depending on the stock, analysts start revising more aggressively down. And then, of course, the beats come in because you're beating numbers, estimates that were really revised, maybe too much. So the real question is, what is the beat rate of the pre-revised numbers? And I don't suspect it's all that good.
All right. Well, listen, thanks to John Butters. Check out his blog post. It's going to drop tomorrow on FactSet's website. I got one question. Okay. This is going to be a little bit of a curveball for you guys.
Rangers, Red Wings tonight. Yeah. The Rangers are in Detroit. The Fathers are there. Rangers haven't been.
Nope. Next week, okay, on the 17th, Alibaba is reporting. Okay.
Yeah, they are.
Let's see if we can throw a chart up here. Okay. Look at
stock traded down to 58 on the 21st of October. I think it closed that day at 62 and change. It traded over 100 million shares since October 31st of 2020. We have seen 7 or 8, 35 to 50% bounces from a low. I think we saw a similar one on the 21st. I think the stock has potential to trade 90. Back to you. All right.
So here's the thing. So next week, we already talked about Biden's meeting President Xi. Okay. Who knows what the hell's going to come out of that? Okay. So you look at a stock like this. To me, this is kind of the poster child for Chinese equities, at least from an American investor's perspective. You know, I'm looking at the implied move in the options market. So the next week, okay, with a stock just below 70, the next week 70 straddle is would cost you, that's the put premium and the call premium put together. It costs you about $7. $7 on 70.
10%.
You divide that gets you about 10% implied move in either direction. Now, if you thought the stock was going to 90, you could buy the next week 70 call. Okay, you would only have a day or so after earnings to earn that out, so you wouldn't want to do that. But you could pay about 3%, okay, which is about 50, 5%. It's about 50% of the size of that straddle. What does that look like to you, Carter? When you look at that chart, you look at a 10% implied move. If you wanted to define your risk and you thought there was a couple catalysts, one being earnings, does this look like an interesting setup to you?
I'm a buyer. I'm with Guy. I'm not sure 90. That's a big jump, but higher. I think it's worth the stretch, as they say.
Okay.
It's worth the risk. I'd bet long.
All right, so we're going to check that one out.
Worth the lemon, or what is what is that?
Worth something. We'll check. Worth charting. We'll check that out next week. Prior to earnings, we'll do a little. Maybe we'll do a
Juice
little.
Is worth the squeeze. I don't know. I hear these dumb sayings that I think people say dumb things every once in a while just to sound smart.
You remember that movie? Heat? They were deciding whether to go in for that last big deal. He said it's worth the stretch. I need the money.
I like that. I love. Can I tell you something? I will say this, and I know I got to get out of here because I got to go to do our podcast. But the three of us were on the desk the other night with CNBC's Melissa Lee. That was fun.
Yes, it was.
Right, Dan? All right, Dan's done.
It was. I mean, I think at this point on Thursday, Carter, Guy and I've spent way too much time together.
Yes, it's like a date, that needs a little break.
We have two more things to do. We have our podcast with Danny Moses that we're going to do this afternoon, and then we have Fast Money, and then we're out. Then we're 5,000. We may not talk for 3 days.
Well, that's not true.
Yeah.
That's it for Market Call. Rangers, Red Wings tonight. The Rangers really got to get their bleep together. I think they do it tonight in the Motor City. Want to thank our sponsors, FactSet and SoFi. If you like today's show, like it and leave a comment on the video. Don't forget to subscribe to Risk Reversal Media on the YouTube. We will be back on Monday, 1 p.m. Eastern time. There's a lot of moving parts next week, so pay attention. It's the cheapest thing you can do. Later.